Jack Bogle, the revolutionary who refused to innovate. When John C. Bogle passed away in 2019, he left behind a paradoxical legacy. A billionaire who could have been far wealthier, a financial industry titan who spent his career fighting the financial industry, and a revolutionary whose greatest innovation was choosing not to innovate. While most Wall Street legends are remembered for the fortunes they made, Bogle's legacy is measured in the fortunes of millions of ordinary investors who never met him. The numbers tell part of the story. By creating the first index fund in 1976, Bogle launched a movement that now accounts for over $20 trillion in assets. Vanguard, the company he founded, has saved investors an estimated $750 billion in fees through its low-cost approach. But perhaps most remarkably, Bogle structured Vanguard in a way that deliberately limited his own wealth, making it a mutual company owned by its funds, which in turn are owned by their investors. In an industry built on the promise of beating the market, Bogle made his mark by refusing to try. While his peers chased trading profits and management fees, he preached a gospel of low costs, broad diversification, and patient holding. The founder of Vanguard didn't just create another investment company. He launched a quiet rebellion against Wall Street that continues to reshape finance today. The paradox at the heart of Bogle's philosophy. Most financial advice follows a simple formula: work with experts, pay for quality, and try to beat the market. Bogle turned this conventional wisdom on its head. His radical insight was that the surest path to investment success is to embrace being average. This seemingly counterintuitive approach flows from a simple observation. When you account for fees and transaction costs, most active investment strategies actually underperform the market. By the time you pay for the expertise supposedly needed to beat the market, you've already put yourself at a disadvantage. The not-for-profit revolution in finance. But Bogle's vision went beyond investment strategy. While most financial companies are structured to extract maximum profit from their customers, he deliberately set up Vanguard as a mutual company owned by its funds, which in turn are owned by their investors. This unique structure means Vanguard operates essentially as a not-for-profit, automatically passing cost savings back to investors through lower fees. This revolutionary model raises a provocative question. What if other financial services followed the same approach? The Bogleheads Guide hints at how this could transform other sectors. 1. Credit cards. Instead of profit-maximizing companies that benefit from keeping customers in debt, imagine member-owned cooperatives focused on promoting financial health. 2. Healthcare insurance. Rather than shareholder-owned corporations incentivized to deny claims, picture mutual organizations spreading risk across communities while minimizing overhead. 3. Student loans. Instead of debt instruments designed to generate maximum returns, envision education funding structured to minimize the burden on students. The success of Vanguard, now managing over $7 trillion in assets, proves this isn't just idealistic theory. It's a viable model that could reshape how we think about financial services. The anti-rules of successful investing. This revolutionary spirit extends to Bogle's specific investment advice, which systematically contradicts what most people consider common sense. Don't strive to be the best. Embrace being average through index funds. Ignore your instincts. Emotions are your enemy in investing. Avoid expensive expert advice. Simplicity beats complexity. Pay less for better results. Cost is the most reliable predictor of performance. When markets crash, do nothing. Activity is the enemy of wealth. Forget past performance. History doesn't repeat in predictable ways. The behavioral revolution. Perhaps most radically, the Bogleheads' approach acknowledges that our biggest investment challenges aren't technical, they're psychological. The book catalogs the mental traps that sabotage even sophisticated investors. Recency bias leads us to extrapolate recent trends indefinitely. Overconfidence makes us think we can predict the unpredictable. The endowment effect causes us to overvalue what we already own. Mental accounting tricks us into holding losing investments too long. The solution isn't more knowledge or better analysis. It's creating systems that protect us from our own worst tendencies. This is why Bogle advocated for simple, automated investment approaches that remove emotion from the equation. A movement, not just a method. The Bogleheads aren't just followers of an investment strategy. They're participants in a movement to democratize finance. Their online communities, conferences, and books spread a message that Wall Street would prefer to suppress. That successful investing is simple, that costs matter more than strategy, and that ordinary investors can manage their own money successfully. This explains why the Bogleheads Guide to Investing, despite its occasionally dry style, remains essential reading. It's not just a manual for personal investment. It's a manifesto for a different way of thinking about finance, one that puts the interests of ordinary investors first. Looking forward, in an era of growing wealth inequality and financial complexity, Bogle's vision feels more relevant than ever. The success of Vanguard has forced the entire investment industry to lower fees and offer index funds. But the broader revolution he envisioned, of financial services restructured to serve rather than extract, remains largely unrealized. The question for readers isn't just whether to adopt the Bogleheads' investment principles, but whether to join their larger project of transforming finance. In a world where financial services too often exploit rather than serve, Bogle's legacy offers a powerful alternative vision and a proven path to making it reality. This is what makes the Bogleheads' message truly revolutionary. It's not just about how to invest better. It's about how to build a financial system that better serves society. In that light, the occasional dry passages and US-centric examples feel like small prices to pay for access to such an important vision.